Hey everyone, welcome back to Corporate Decoder, the place where we, decode corporations. Today we're diving into Moog's latest quarterly report, and trust me, you won't need a fancy engineering degree to understand this. Unless you want to build a rocket, then maybe you should have paid more attention in engineering class, but jokes aside, it's all about numbers and a bit of corporate strategy. This report is for the period ending in late March, and the big headline is, while sales are up slightly, profits are down. So let's find out what the heck is going on. First things first, this is a Form 10Q, which is basically a quarterly checkup for publicly traded companies. They have to tell the Securities and Exchange Commission, the SEC, all the important details about how they're doing. This includes the financial results, any big changes, and potential risks. This report covers Moog's financial performance up to March 29, 2025. Moog has two classes of common stock, Class A and Class B, both listed on the New York Stock Exchange. Because of its size and market influence, Moog is considered a large accelerated filer, meaning the SEC wants their reports fast. As of April 18, 2025, there were over 28 million shares of Class A stock and about 3 million shares of Class B stock outstanding. This is important because it tells you who owns what and how voting power is distributed. Now let's dive into the good stuff, the financial numbers. We will jump to the condensed statements of earnings to see if Moog is making or losing money. Okay, so Moog's net sales are up a tiny bit. For the 3 months ending March 29, 2025, they made about $935 million the year before, a $530 million the year before. A $5 million increase isn't that much for a company this size, right? Looking at the 6-month picture, sales are up from $1.79 billion to $1.85 billion, which is a bit better. Almost a 3% increase. Gross profit actually went down for the quarter from about $267 million to $256 million. That's a drop of over $10 million. But for the 6-month period, they are nearly identical. Spending on research and development is down from roughly $28 million to $24 million for the quarter and $59 million to $48 million for the 6 months. It shows that innovation has slowed down at Moog, which is not exactly something that Warren Buffett wants to see. Here's the most important number, profits net earnings. For the quarter, it dropped from $16 million to $56 million. That's a 7% decrease, but again, let's zoom out. For the 6-month period, we see almost no changes. Earnings per share, which is what each share of stock earns, also saw a minor reduction for the quarter, but the numbers are nearly identical for the 6-month period, which is positive. Okay, let's move to the next big statement, the consolidated condensed statements of comprehensive income. This is where we see all of the extra factors that affect value of a company. Again, you see those earnings, but we care about the big picture, that number just above comprehensive income, which says other comprehensive income loss net of tax. Here we see a big swing. For the 3 months ending March, it went from negative $11 million to positive $25 million. On the 6-month view, it's a change from positive $21 million to negative $13 million. So what this means is that their comprehensive income or total income is going up for the quarter from $48 million to $80 million, but slightly down for the 6 months. Total assets increased from $4,009 billion to $432 billion. That's mainly due to an increase in receivables, which is the money owed to Moog at its customers, jumping from $420 million to $530 million to $57 million. Now onto liabilities and equity section. Total liabilities are up from $223 billion to $2.48 billion. Digging in a bit further, we can see where this is coming from, and we see their long-term debt increased significantly from $874 million to $1.16 billion. Finally, shareholder equity is down. This could be from a lot of factors, but in general, you never like this number to go down. It's the real value that belongs to the investors. It went down from $1.86 billion to $1.84 billion. Now, one of the most important things to Buffett is the consolidated condensed statements of cash flows. It's the most realistic report. We can see our old friend net earning from the other statement. And then we see all the accounting tricks that are used to try and make earning look pretty. This area reconciles the difference. But the big one and real one is down there. It went from being a positive $16 million in cash to negative $93 million. Again, timing can be a factor in these things, but that kind of negative swing is almost never good. It gets even worse. They're a double whammy. Cash from investing is also in the negative, driven by investment in new machinery, facilities, equipment. Now, depending on your point of view, investment is good and bad. MOOG took out $752 million in revolving lines of credit and paid down $462 million, but you have to ask yourself what for. And they still paid dividends. That's nice for shareholders, but I don't know. Sounds like a mixed match to me. Quickly, one interesting tidbit before leaving. We see Treasury shares issued as compensation 6,288. So that's how much the company paid out in shares. It's not super material, but always good to keep in mind. There have been no major accounting rule changes, so we can skip that. The company notes an out-of-period adjustment that increased costs and decreased unbilled revenue by $7.5 million because of warranty adjustment. While this wasn't material, it shows that management's accounting isn't perfect. The amount of unbilled is still pretty high, $733 million. This is pretty normal for long-term government contracts though. Checking long-term debt, we see a big jump here as well, from $874 million to $1.16 billion. That correlates with our numbers from the cash flow. The last note, XCT and SERP Trust is an employee compensation trust. This part matters because the trust has shares of MOOG which is being used for compensation. And now let's jump to risk factors to see what the company thinks can go wrong. Two of these factors are directly tied to the company's success, and by reading these you can understand what management prioritizes. The main risk factors cited in the document are competition, cyclical markets, government contracts, supply chain issues, and the reliability of their accounting estimates. Finally, okay, that was a lot to take in. Now, summing things up. Opting out MOOG, some things stand out. Sales growth is slow, profit margins are thinning, debt has increased dramatically, they spend a lot to please investors, which is not always the best, especially if the main financials aren't in order. The strengths they have are a solid position in aerospace and defense industries, as well as long-term government contracts. I would not short or long this stock personally. It's pretty stable right now. The long-term vision of this company is unknown. So for now, I'm going to stay away. Thanks for watching. Be sure to like, comment, subscribe, and hit that notification bell so you don't miss when we next decode a corporation.